So we think in the second half, volatility is going to remain elevated as investors are still pricing in a rapid Fed pivot and also a pivot by the ECB, resulting in a soft landing. Fixed income markets are sending very clear signals that rising risk of a recession is going to trump the risk of inflation. We're seeing that in flattening curves and higher high yield spreads. Europe most certainly is going to experience a recession, and the US is on the same trajectory to enter recession later this year or in the first half of 2023. So the setup is we have all major central banks except China and Japan tightening conditions into a severe global slowdown. We're still positioned with elevated cash. We've taken some profits in our energy holdings as disinflationary pressures rise, but we're building a shopping list to add to new positions and to existing positions as the market starts to discount lower earnings over the next 12 months and lower growth estimates. So a lot of investors wonder, can the Fed really get it done? From an investor's perspective, the short answer is no. We've shifted to an environment where the Fed and the ECB's number one goal is to make sure that the sovereign entity, in the case of the US Treasury, is solvent and financeable. It's simply a fact that at 3% interest rates, the sovereign isn't financeable. Interest alone would approximate 20% of tax receipts. So the Fed is in a difficult position. We have to get short rates in medium term part of the curve back or below 2%. In order to do that, they either need to tighten financial conditions, creating significant weakness in the economy and risk assets so that investors force the curve lower, or they'll be forced to pivot quickly and utilize unlimited QE and yield curve control, rising inflation expectations, and further eroding fixed income markets. So it's a precarious position for market participants, and the Fed's in a very difficult spot. We think we're in a multi-year energy crisis, but that doesn't mean energy prices only move higher. There's currently a geopolitical premium in energy prices, and a recession can certainly curtail demand, which could lower the current price we're experiencing. That said, we're seeing disinflationary pressures develop in the rest of the commodity complex, but certainly the market's going to continue to have caution as energy prices have severe risk to the upside for the foreseeable future. When you look at valuations, certainly non-US securities are more attractive from a valuation standpoint than the US equity market is. That said, some of that is just the disparity in forward growth expectations, but there really are attractive opportunities all across the globe, across all sectors, and there's equal levels of risk as well. If I was an investor, I would tend to focus on global strategies at this point. While the US has done well relative to the rest of the world, that's not going to be the case over the medium term. And it's going to be really difficult for an individual investor to tactically address the rotations across the globe. Inevitably, they'll be reacting to historical returns and not necessarily when the opportunity is ripe for making the move. So I think global strategies are more attractive than domestic US strategies currently.